DLF, one of the largest real estate developers, very big presence in the NCR, everybody knows that. But DLF also recently inked a deal with the Sovereign Fund of Singapore, GIC, selling 33% stake in the rental arm. The 9,000 odd crores expected to help the developer become a debt-free company. And while the last quarter wasn't great, the key is that at the Morgan Stanley conference, the management spoke about how the residential market has picked up and they expect a good sales ramp up in Q1 FY19. So, well, let's talk about good news from a corporate. Saurabh Chawla of DLF needs no introduction, really joins me right now on the show to talk about, well, maybe how the quarter has been like and how the outlook ahead is like. Saurabh, good having you. Thanks so much for joining in. This is Neeraj here. Good morning. You know, we were at the conference. We saw the notes that Morgan Stanley put out post the conference. And you seem to be a lot more, you as a company, I mean, seem to be a lot more optimistic than what the street is about businesses which are largely, you know, in a manner of speaking, seasonal and get impacted by monsoons. You have said that the residential market has picked up. Give us some details here.
Well, we've been consistent in our guidance to the markets. Last year we were talking about green shoots and also the overhang, the sentiment overhang because of many of the developers going belly up. That had impacted absorption levels in many micro markets where, of course, we are present. As things, solve themselves out, we see a much better environment for sales to happen, and fourth quarter of ours actually reflected that. So I would actually contradict your comment that last quarter wasn't good. Actually, if you look at our last quarter, our gross sales was more than 1,000 odd crores. So things are much, much better than what they were a year back, and we hope as resolutions happen on many of the companies which were in the real estate space, the customer sentiment will become much more buoyant. Last but not the least, real estate is very heavily correlated with the GDP growth, and hence as things start to move on that end also, there will be better demand perspectives for us and for other real estate companies.
Actually, Saurabh, can you, I mean, what I meant by quarter four was that by and large brokerages may be expected to do a tad bit better on multiple parameters. Maybe there were a couple of misses here and there, which is why they have said that the quarter was a miss. But nevertheless, having said that, can you extrapolate on that point? Because when we speak to at least the developers in the Mumbai region, they're talking about how the market doesn't seem to be picking up meaningfully. And here is it you who are saying that the residential market has picked up. Is it because of the regions that you're operating in versus some of the other buckets? Or is DLF as a company, by virtue of it being a large player and having the brand equity that it has, is able to do something that some of the others are not being able to?
No, I think you see, real estate is pretty much a micro market driven play. So, South Mumbai will have different dynamics versus, let's say, New Delhi or suburban Mumbai will have very different dynamics to, let's say, Gurgaon or New Gurgaon. So you have to look at various micro markets and see the guidances which the real estate companies are issuing. We usually do not issue any guidance, although in the fourth quarter we did issue a guidance where we said that we are now confident to give a steady state sales outlook of about 2,000 to 2,500 crores on an annual basis. So, things have improved, and we are confident that we should be achieving sales numbers of this magnitude as we go forward. Do also note, I mean, last year we had shut our sales because of enactment of RERA, and of course there was some disruption as GST got really implemented. So, keeping all that into account, I think FY19 would be a much better year for DLF for sure, and I'm sure for the whole real estate industry.
Apples to apples, Saurabh, when we say that residential market has picked up, at least in the Q1, one would be volumes, two would whether prices are also showing some signs of stability or a pickup as well. How would you respond to both of these?
I won't say the prices have gone up. There is enough supply available. I would say the absorptions have gone up, so hence volumes would have surely improved on a Q and Q basis. For us as a specific story, as we have completed most of our projects, barring one, actually all projects are completed. We are selling completed inventory. So the markets have actually veered towards a completed product rather than a product which is currently under construction with delivery few years down the road. So the buyers have become far more conservative. They prefer to have a completed product. They don't want to take any credit risk or a performance risk on a developer, whatever the name it may be, and hence we see demand veering towards that. So developers who are completing their projects or can give assured visibility of the completion of their products are seeing their inventory move. And as we go forward, I think this will only gather more momentum.
That's a report by Anarock which says that the number of units being launched, the new launches absorption in the NCR region has inched up. In fact, new launches, I presume, in NCR are more than double. You just spoke about you selling a lot of finished inventory. What about new product launches? Have you guys meaningfully done some project launches in the NCR region in the last 2 or 3 odd months?
No, we have only launched one project for construction. So we are not doing any pre-sales unlike other developers. This is a project which is called Midtown in New Delhi, which is adjacent to our earlier project called Capital Greens. So that has gone, we have broken ground over there. It's more than 7 odd million square feet of residential, which incidentally is also in a joint venture with GIC. That is a project that the build out has started to happen. Other than that, we are right now concentrating on completing and delivering the finished inventory. So our focus is in a different fashion because if you would know that now the accounting standards have changed, and hence for us capturing of revenue and profits on a POCM method would not be actually applicable. It will be on delivered product actually. So a completed method of accounting, and hence the faster we deliver and give possession to the customers, we are able to capture our revenue and margins over there. So our focus is a little different from other players, and hopefully I think that should reflect in our results going forward.
Yeah, well, we'll watch out for all of those on the next 4 quarters as well. So just one quick update. A couple of comparable peers in the last 18 odd months have had a slightly differentiated model in the sense that they are approaching land bank owners with the prospect of partnering them by merely lending the branding and construction and revenue sharing. Age-old model, but comes to prominence in the last 12 or 18 odd months very, very strongly. Now you are somebody who's got a very large land bank, but do you also envisage doing that kind of a model because of branding that DLF would enjoy?
No, we won't. We, as I said earlier also, and it's also reflected in our performance over the last few years, we have enough land bank for future launches, and our concentration over the next 2 to 3 years would be to complete the sales of our completed inventory, and of course do new launches from the construction perspective in various geographies. So it will be mostly Delhi and other geographies like Chennai and Hyderabad, where our focus would be. And also from the product line, the focus would be more commercial, rather than residential. So you can look at it as if we are rebalancing both geographic risk and product risk over here. The idea is or the business model now is to actually sell completed property. And hence the focus of ours would be on constructing new projects and making them ready for delivery 3-4 years down the road, overlaying the current completed inventory which is anyways going to be sold. So we basically add layers on layers as we go forward, and unlike go on to a model where you do a lot of launches and then you start to capture POCM revenues and profits. So that is now a passe actually.
Okay, interesting. Maybe for the industry as well. Let's see. Maybe they're going to differentiate results from companies over a period of the next 12 months. One question on the rental arm as well. I think you were on record saying that you would consider acquiring completed rent-yielding assets in the Mumbai and in the Bangalore markets.
Yes, we are always open to thoughts over there. Recently, we did get a few opportunities. Things didn't work out. But we, along with the GIC as our partners in DCCDL, are open to any completed inventory or new projects that may be there in the commercial space in geographies like Mumbai and Bangalore. In other cities, we are already present, so hence our focus is only in these two cities, and we're quite open to those opportunities.
Okay. Well, we will talk about your numbers when you do come out with them in the month of July. Saurabh Chawla, many thanks for joining in today and giving us this perspective, and all the best with the newer model.